Hello everyone, welcome back to the channel. In today's video, we are talking about something that's not flashy and definitely not going to double overnight, but it might just be the smartest way to actually build wealth. We are talking about blue chip stock. Companies like Apple, Berkshire and JPMorgan. These are the giants. They move slowly, but when they move with purpose. They don't chase headlines. They make the headlines. They make them. And while everyone chasing the next 10x growth stock or the next meme coin, the truth is long-term wealth is often built on business that are boring, predictable, and relentless profitable. So today we will break down what blue chip stocks really are, why they are considered the backbone of any series portfolio, and how to actually pick them based on your own goals and market conditions. We will also talk about 3 prime examples: Apple, Berkshire and JPMorgan, and what you can learn from how they operate. And if you stay until the end, I'll show you how I personally structure my watch list for blue chips, so you can start building one too. Starting with basics, what exactly is blue chip stock? In simple terms, a blue chip is a company that's large, stable, profitable and trusted. The term blue chip actually comes from poker, where the blue chips are worth the most, and it's a perfect metaphor because these companies have proven their worth over years and years. They survive recessions, they generate consistent cash flow, they usually pay dividends, and they are run by leaders who think in decades, not just like quarters. They are not designed to make you rich overnight. They are designed to keep you rich for a lifetime. And that's the difference between speculation and investing. When you own a blue chip stock, you are buying history, discipline, and track record that survived every kind of a market imaginably. Let's start with Apple here. Apple's story isn't just about technology. It's about habit. It's about how a company can become so ingrained in people's life that its products stop feeling like product. They become part of identity. Every year, people line up to buy a slightly better version of something they're already on. You can take example of you. Like when you buy, you still wait for the new product to come out so you can buy it. You wait in the queue. And that's the brand power on a level most companies can also dream of. But what makes Apple a blue chip isn't just a popularity, it's consistency. Consistent revenue, consistent profit, and consistent return to shareholders. Apple has turned into a cash flow machine. They generate more free cash flow than most countries' GDPs. Imagine this. And they have used that cash flow to buy back shares, reduce debt, and pay dividends, all while continuing to innovate in services, wearable and soon like AI. And here is the key lesson. Apple proves that a company doesn't have to grow explosively to grow reliably. So slow, predictable growth compounded over time. It always beats chasing hypes, and every single time. Now let's talk about Berkshire. If Apple is about innovation, Berkshire is about discipline. It's Warren Buffett's masterpiece, a living example of how passion and simplicity can outperform almost anything else. Berkshire isn't one company. It's a collection of great businesses: insurance, energy, railroads, consumer goods, and all built around one simple principle. Buy strong companies, hold them forever, and let compounding do its work. Buffett once said, "Our favorite holding period is forever." And that mindset is what separates real investors from traders. The fascinating part about Berkshire is that it doesn't even pay a dividend. So here is the question. Why shareholders love it? Why? Because the value creation inside the company compounds quietly. Buffett reinvests profits into opportunities, letting your money keep working without you doing anything. The lesson from Berkshire: great investing isn't about speed, it's about direction. and staying consistent with direction for decades. And finally, we have JPMorgan Chase. This is the definition of a financial fortress. This is what I love about JPMorgan. JPMorgan isn't just a bank. It's the engine that powers much of the global economy. They handle trillions in assets. They are deeply embedded in global finance, and they have managed to stay profitable through every financial storm. The thing I love about JPMorgan is how they balance risk and reward. They lend, they invest, they advise, but they also keep one of the strongest balance sheets in entire banking system. And under Jamie leadership, they have avoided most of disaster that took down their competitors. The reason JPMorgan is considered a blue chip, it's simple. They make money in any environment. High rates, low rates, bull markets, bear markets, they adopt. And that's what you want from a blue chip. Like, it's not excitement, but it's endurance. So how do you actually use blue chips in your portfolio? Here's what I tell people. Number one, think of them as your foundation. If your portfolio was a house, blue chips would be the concrete base. They keep every stable while you take risk elsewhere. Number two, use them to balance volatility. If you own riskier growth or speculative stock, blue chips help smooth out returns when the market gets rough. Number three, reinvest the dividends. Dividends might look small, but when reinvested, they quietly compound into serious money. Number four, don't expect fireworks. Always remember, don't do that. Expect wealth. These aren't the stock that double overnight, but they also don't collapse overnight. Blue chips are about peace of mind, and in a world that's constantly chasing the next big thing, peace of mind is one of the most underrated assets you can own. So yeah, those are your blue chip stocks. Apple, Berkshire, and JPMorgan. They don't promise excitement, they promise endurance. And the truth is, most people lose money in the market not because they choose the wrong stocks, but because they chase the wrong speed. If you can slow down, zoom out, and think in decades instead of the days, you will be ahead of 90% of investors out there. This is what every person needs to look into the market, how to invest, how to analyze the market, what stock is better for that person. So study basic, study hard, look into the markets, look into the stocks, look into the companies, what they offer you. So in the next video of this series, we will look at cyclical stock, the ones that rise and fall with the economy. And I'll show you how to identify them early before the next cycle turns. If you found this video helpful, drop a like and please subscribe to the channel. It would be helpful to grow this channel.